Hello everybody and welcome back. My name is Javier and I'll be your host for today. Just to recall what we spoke last time we spoke about the Forex market, how the Forex market works. And at that time we provide you with one strategy so you can make between $300 and $500 in a week using the Fibonacci retracement based on support and resistance. Okay, today we're going to talk about a different investment tool. We're going to talk about the stock market, how the stock market works, and obviously we are going to provide you with Stock Screener. The reason why we use a Stock Screener is because we want to pick the best stocks available so we can be profitable in this market as well. For those of you that do not understand how the stock market works or what the stock market is, let me give you a brief introduction. Okay, probably you heard people talk about the market or stock market. The reason it is called the stock market is self-explanatory. Markets are where a stock or share of publicly traded companies are bought and sold. Okay, generally speaking, the stock market is made up of organized places where buyers and sellers meet to buy and sell. All right, similar to a farmer's market. While a farmer's market is made up of various stands of booths where crops and crafts are bought and sold, the stock market is made up of different exchanges where people meet to exchange stock for money. Okay, so that's pretty much the basics of the stock market. Okay, stock investors often go long in the market by buying shares in anticipation of a price rise. All right, so in here pretty much what we're going to do is buy stock that can be profitable in the long run. For example, so let's say that we want to buy stock that is trading at $10 right now, with the hope that in 6 months, 7 months, or even a year can double the price, can go to $20, so you can get a return on your investment. Pretty much in this case 100% return on your investment. Okay, but why invest in stocks? Stocks are but one of many ways to invest your hard-earned money. Why choose stocks instead of other options such as bonds, rare coins, or antique sport cars? Quite simple. The reason that savvy investors invest in stocks is that they provide the highest potential returns, and over the long term no other type of investment tends to perform better. In fact, so far this year the stock market is the best stock market in the world, providing with about 17.8% return so far. Okay, so for those of you that are interested in the stock market, what I'm going to do is I'm going to send this PDF file explaining a little bit about different world indexes. In this case about the stock market, for example the S&P, which is up to date July 15, 2013, is 17.8, and as we can see in here is the highest return if you compare to the world indexes. In this case 15.3%, for example. Europe 8.2%, and emerging markets with a negative number of minus 5.8. So far the best index in the world is the S&P 500 with 17.8% return to this day. Okay, so that is why we invest in the stock market. All right, so those are the basics. Now let's talk about the screener and how the screener work, so we can give you the best stocks available so you can pretty much pick the winners. All right, so in here we have different screeners, free screeners, and that's what we're going to try to find today. For example, if you go to Reuters.com, you can go and look for stock screener. All right, they will give you different criteria, for example price earnings. I'll explain this a little bit, but you can go between 0 and 15 and they will give you, you can choose between the numbers that you want to. All right, it's a little bit harder to use this specific screener. And if you go, for example, to barchart.com, they will give you a screener as well. Now if you're not familiar with stock market, it will be hard to use this specific screener. The screener that I like, and it's free to you, all right, is the free stock screener from finviz.com. All you need to do is go and type finviz.com, as you can see in here, finviz.com, And after you type that, you can click on screener. All right. Once you click on the screener, what we're going to do is going to, based on some criteria, and this is what I want you to write it down right now. Okay, and I'll explain this to you and why are we using this specific screener. So first of all, themebeast.com is a free screener. It's simple to use, very simple to use, and obviously is complete, a complete one. All right, so after we click on screener, we click in all right, and the first thing that I'm going to choose in this, we don't have to pick every single one, is the earnings per share. All right, why we choose the earnings per share? First of all, it's pretty much based on because these specific criteria serve as an indicator of a company's profitability. All right, so what we're looking for is a company that's been profitable in the past 5 years. All right, for this matter, we can change, but based on our own experience and based on the economy performance so far, we think over 10% is a great number. All right, so what we're doing with this one is pretty much looking for companies that has been profitable or have been profitable in the past 5 years with 10% earnings per share. Okay, the next one in here is the beta. All right, for those of you that do not understand what the beta is, pretty much the beta is a means that as asset generally follows the market. All right, so if we look for a beta of 1, for example, pretty much what we're saying is this specific stock or specific stocks are following the market 1 to 1. Okay, so if the market, for example, moves 1%, these specific stocks tend to move 1% as well. So pretty much a mirror of the stock market. Okay, with this in mind, for example, if the stock market this year so far is returning 17.8%, once we choose a beta of 1, these stocks probably will provide a 17.8% or in that range, specific range. Okay, if we increase the beta, let's say to 2, what we're saying is these specific stocks tend to be more volatile, and if the stock market is giving you 17.8%, this can double that specific. Now with that in mind, you have to be careful because you can make more money obviously, but at the same time it's more risky, and you can, at the same time increase your risk, in this case twice as much. So for that matter, we're looking for one specific number, beta of 1. Trying to do is pretty much saying we want stock that is pretty much doing what the stock market is doing. So for that matter, and just to keep with that, over 1% will be fine. Okay, we don't care about the price right now. The next specific one that we're trying to do is the price earnings, the second one in this one. Okay, this one is telling us a valuation ratio of a company's current share price compared to its per share earnings. All right, so price earnings, again looking for one specific number that is less than 20. Why are we choosing less than 20? First of all, if you choose a number that is over 20, what we're looking at is stocks that are expensive. We're trying to find stocks that are not expensive and that can pretty much be on a fair price or undervalue. With this specific ratio, under 20, that is exactly what we're looking for. Okay, another one that we're trying to find in here is the same in the same category, earnings per share. Next 5 years, we're looking for companies that tend to be positive based on forecasting. All right, in this case we're looking for the same criteria, over 10%. Okay, pretty much we're saying, okay, we need companies that are doing well or going to do well in the next 5 years. All right, so once we start these, we saw this number close to 6,000. Now, based on our criteria, we have about 169 companies. Obviously, the ideal number is between 10 and 20 companies, because 6,000 companies are going to be hard to pretty much follow, but between 10 and 20 probably would be a great number. Okay, the next one that we're going to find is in the next column. We don't care about the sector. Forward PE, obviously, we're going to look for companies again that are not overvalued, and we're going to look for that specific number again, under 20. We want to keep consistency pretty much. Earnings per share the past 5 years over 10%, earnings per share next 5 years over 10%. Undervalue pretty much in the same. We don't want companies that overvalue. All right. And another one that I like to use is just that return on equity. All right. So with this, what we're trying to do is, or this ratio is a measure of a corporation's profitability that reveals how much profit a company generates with the money shareholders have invested. Okay, so this is important because if you invest in a company, you want something in return. Okay, so return on equity, we're looking for a company that is at least over 10%. Okay, so what we're saying with this is, if I invest $100 in a company, I'm expecting at least 10% of that, or $10 as a return on equity. So that one is really important. Now, from the 166 companies that we saw last time, now we're about 133. Remember, our ideal number is between 10 and 20. Okay, we're not going to look for any technical indicators in this case, but we're looking for the price per earnings growth, PEG. Okay, this ratio is used to determine a stock's value while taking into account earnings growth. Okay, so it's similar to the PE, and obviously looking for an under value company, not an overvalue. Okay, it's like you buying a house. You don't want to buy a house that is currently selling for $400,000. We think it's overvalued. We're looking for a house, a beautiful house that is undervalued. All right, so under 1 will be our ideal number with this specific criteria. So looking for that, we have about 74 total right now. All right, so let's move on to the next criteria. Earnings per share. This year we have that already in consideration, so we don't need to look for another one in that area. All right, so and then we move on to the next column, country. Since the United States is doing better than the rest of the world, we can look for companies that are trading in the United States. Local companies, and we decrease to 60. And then sales growth quarter over quarter, again positive over 10%. Okay, quarter over quarter. All right, and institutional ownership. What we're trying to accomplish with this specific criteria is pretty much follow what the big institutions are doing, right? So we want companies that at least are owned by this big institution, and they own over 40% of these companies. All right, so with that matter, with the specific criteria, we got into 20 companies. Current volume, we don't really care about that, but one that I forgot to mention is an average volume. What we're trying to accomplish with these, we're talking about companies that are very liquid. When we talk about companies that are very liquid, pretty much saying, okay, if I buy a company right now, I can easily sell tomorrow with no problem at all. For this specific matter, where we're looking for companies that at least 200,000 traders are involved on a daily basis. Okay, so over 200,000. Let's look at this one, over 200,000, 2 million over 200K. Okay, so very liquid, buying and selling. With that in mind, we only have about 14 companies, all right, that pretty much we can create a portfolio and we can follow these companies. All right, so this is how you use the stock screener. The reason why we use the stock screener is because we want to pick winners, stock companies, or in this case stocks that are winners. All right, so because we want to be profitable in the stock market, and for that specific matter we use the screener. And so remember, you can use the free screener. There are other websites that provide screeners as well. Some of these websites, they charge you for that screener. Some other ones, like Reuters for example, are a little bit harder to use, or barchart.com, they have stock screener as well, but you have to have some knowledge on this. Finviz is clear, it's complete, and obviously you have all the tools that you need to understand these specific stocks. Okay, if you need to, I can give you a free PDF file that pretty much explains the performance of all the indexes, either in the United States or in Europe, around the world, and it will give you really clean details about specific stocks. And on top of that, what I'm gonna add is something that we created. This is pretty much a stock screener. If you didn't understand something that I put out there, I have this free Excel chart that explains everything, and what specific criteria we're looking for and why are we using that. Okay, so please feel free to contact us and you will get this Excel sheet for free, and also the PDF file that explains all about the stock market and markets in the world, and how they've been performing in the past 6 months so far, or 7 months I'll say. Okay, that's it for today. I hope to see you soon, and I hope to hear from you. All right, you have a wonderful day. Bye.